For more stock news updates, remember to press the like button and subscribe. With that being said, let's get straight into the video. Raymond James has recently reaffirmed a market perform rating for shares of Palantir Technologies. This decision follows an update to their financial model, reflecting new developments that could impact the company's financial performance. According to data provided by Investing Pro, Palantir shares are currently trading at a price-to-earnings ratio of 304.47. This high ratio is indicative of significant investor expectations for future growth. Over the past 12 months, the stock has delivered a remarkable return of over 293%, underscoring its ability to generate substantial gains for shareholders. However, some analysts believe that the stock is currently priced higher than its fair value, which may warrant caution for new investors. A key factor influencing the updated financial model is the vesting of stock appreciation rights, valued at approximately $120 million. These rights were triggered during the fourth quarter of 2024 as Palantir's share price exceeded $50. This milestone reflects the company's strong stock performance, but it also introduces additional compensation-related expenses that need to be accounted for in financial projections. In response to these changes, the analyst at Raymond James revised the company's earnings forecast for the fourth quarter. The updated model now predicts a decrease in generally accepted accounting principles earnings per share by approximately 5 cents. This brings the estimated earnings per share down from 6 cents to 1 cent. Such adjustments highlight the impact of stock-based compensation on the company's bottom line, a factor that investors may want to consider when evaluating Palantir's financial health. Despite this reduction in generally accepted accounting principles earnings per share, other key financial metrics remain unchanged. Projections for adjusted earnings before interest, taxes, depreciation, and amortization, as well as adjusted earnings per share, are steady at $321.7 million and 11 cents respectively. This stability indicates that the company's core operations continue to perform well even in the face of increased expenses. Palantir's gross profit margin, which stands at an impressive 81.1%, further reinforces its ability to generate significant revenue relative to its costs. Additionally, Investing Pro analysts have rated the company's financial health as excellent, reflecting its strong position in the market. The report from Raymond James also emphasized the importance of focusing on revenue growth and adjusted earnings metrics when assessing Palantir's performance. While generally accepted accounting principles metrics may highlight certain cost challenges, these figures are not always the primary indicators of a company's success. Instead, metrics such as adjusted earnings per share and adjusted earnings before interest, taxes, depreciation, and amortization provide a clearer picture of operational efficiency and profitability. The analyst also commended Palantir's strategy of aligning employee compensation with shareholder value creation. While this approach has led to a modest reduction in generally accepted accounting principles earnings per share, it demonstrates the company's commitment to incentivizing long-term growth and success. Looking ahead, there is optimism about Palantir's potential within the artificial intelligence sector, which is expected to experience rapid expansion in the coming years. The analyst highlighted Palantir's strong positioning within this dynamic industry, noting its ability to leverage advanced data analytics to meet the evolving needs of its clients. However, the decision to maintain the market perform rating reflects the belief that Palantir's stock requires time to consolidate its substantial gains from recent years. This period of consolidation could allow the company to mature into its current valuation and better position itself for sustained growth. Turning to other recent updates, Palantir has been the focus of mixed analyst ratings. Morgan Stanley downgraded the company to an underweight rating due to concerns over its valuation. Despite this downgrade, Morgan Stanley acknowledged Palantir's positive trajectory within the artificial intelligence market, which continues to generate excitement among investors. On the other hand, Wedbush maintained an outperform rating for Palantir, citing the company's strong presence in the rapidly growing artificial intelligence market. Wedbush analysts believe that Palantir is well positioned to capitalize on the increasing demand for artificial intelligence solutions, which could drive further growth in the years ahead. Additionally, UBS analyst Carl Kierstead initiated coverage on Palantir with a neutral rating and a price target of $80. His analysis was based on in-depth discussions with 17 major Palantir customers. These conversations aimed to shed light on the company's core offerings and the potential benefits they may derive from integrating artificial intelligence-driven data analytics. This approach reflects a growing interest interest in understanding how Palantir's solutions can be leveraged to address complex challenges across various industries. In terms of new contracts, Palantir recently secured a significant agreement with the United States Army valued at approximately $400.7 million. This contract highlights Palantir's ongoing role in providing advanced data analytics solutions to the military sector, further solidifying its reputation as a trusted partner in national defense. The company has also launched its Warp Speed initiative, which aims to advance American manufacturing through the integration of artificial intelligence and cutting-edge technology. As part of this initiative, Palantir announced its first group of partners, including Anduril Industries, L3Harris, Panasonic Energy of North America, and Shield AI. These collaborations underscore Palantir's commitment to driving innovation and supporting the growth of critical industries. Despite these positive developments, not all analysts share an optimistic view of Palantir's prospects. William Blair has maintained an underperform rating for the company, citing concerns about its revenue projections. This divergence in analyst opinions reflects the complexity of evaluating a company like Palantir, which operates at the intersection of technology, data, and artificial intelligence. In other news, drone stocks have been gaining significant attention as the demand for advanced unmanned aerial technologies continues to rise across various industries. At the forefront of this surge is RedCat Holding, a prominent player in the drone technology space. The company's recent collaboration with software leader Palantir Technologies has propelled RedCat into the spotlight, significantly enhancing its visibility in the market. Over the past 12 months, RedCat's stock price has surged by more than 1,000%, reflecting growing confidence among investors. Analysts are particularly optimistic that the current administration will channel substantial funding toward US-manufactured drones, creating additional tailwinds for companies like RedCat that prioritize domestic production. While RedCat recently reported quarterly earnings that fell short of expectations, the company remains committed to its long-term growth strategy. Notably, it revised its revenue guidance for 2025, increasing its projection from $50 million to a range of $80 million to $120 million. This upward adjustment underscores the company's belief in its ability to capitalize on the growing demand for drone technology. For investors eager to explore opportunities in this rapidly expanding sector, RedCat presents a compelling option. RedCat is not just another drone manufacturer, it is a technology-driven firm that seamlessly integrates cutting-edge robotic hardware with advanced software solutions. The company's offerings cater to a diverse range of industries, including military, government, and commercial sectors. RedCat operates through two primary subsidiaries, Teal Drones and FlightWave Aerospace. Both subsidiaries are instrumental in developing advanced intelligence, surveillance, reconnaissance systems, and precision strike technologies, positioning the company as a leader in its field. Among RedCat's innovative products is the Teal 2, a compact unmanned drone equipped with state-of-the-art thermal imaging capabilities that provide superior performance in low-visibility conditions. Another standout product is the Edge 130 Blue Tricopter, which boasts enhanced endurance and range, making it ideal for complex operations. Additionally, the company offers Fang, a series of drones designed to comply with National Defense Authorization Act requirements. These drones are specifically tailored for military use and feature precision targeting capabilities, further strengthening RedCat's reputation as a provider of mission-critical technology. In a groundbreaking move, RedCat recently announced a strategic partnership with Palantir Technologies to incorporate advanced visual navigation and artificial intelligence technology into its Black Widow drones. This partnership marks a significant milestone as it comes on the heels of the US Army's decision to select the Black Widow for its short-range reconnaissance program. Palantir's visual navigation software addresses a long-standing challenge in drone operations. Jeff Thompson, the chief executive officer of RedCat, expressed his enthusiasm for the partnership, noting that the integration of Palantir's technology elevates the Black Widow to one of the most effective drones deployed by the Department of Defense. This collaboration not only enhances the capabilities of RedCat's drones, but also reinforces the company's strategic position in the defense sector. Turning to financial performance, RedCat's results for the second quarter of 2025 showcased mixed outcomes. The company reported revenue of $1,530,000, falling short of analysts' expectations by $2,600,000. Year-to-date revenue amounted to $4,300,000, reflecting a 24% decline from $5,700,000 during the same period in the previous year. This decline is largely attributed to the company's deliberate focus on shifting resources toward the Black Widow model, with mass production slated for 2025. Operating expenses during the quarter reached $9,120,000, resulting in a net loss of $13,300,000. The generally accepted accounting principles earnings per share stood at negative 17 cents, missing consensus estimates by 8 cents. The company also reported operational cash usage of $12,500,000, marking an 11% increase compared to the prior year. These increased expenditures were primarily driven by the company's investments in staffing and resources to meet the demands of upcoming initiatives, including its Army contract and anticipated sales of the Black Widow and Edge 130 drones. Despite these short-term financial challenges, RCAT remains focused on its long-term objectives. Management is confident that the company's selection as the winner of the U.S. Army's Short-Range Reconnaissance Program will enable it to achieve its projected revenue guidance of $80 million to $120 million for 2025. From a market perspective, RCAT's stock has shown remarkable performance, climbing by over 190% in the last 3 months. The stock currently trades in the upper range of its 52-week price band, which spans 56 cents to $15.27. It also demonstrates strong momentum, trading above both its 50-day and 100-day moving averages. These trends suggest sustained investor interest and confidence in the company's growth potential. While RCAT's stock lacks widespread Wall Street coverage, this is likely to change as the company continues to execute on its growth strategy and deliver on its commitments. At present, the stock trades at a significant premium to its sales with a price-to-sales ratio of 39.74 times. This valuation reflects both the high-risk and high-reward nature of investing in an emerging growth company within the drone sector. For investors willing to embrace the associated risks, RCAT offers an intriguing opportunity to participate in the sector's growth story. In summary, RCAT Holding is making significant strides in the rapidly growing drone industry. The company's partnership with Palantir Technologies, coupled with expectations of increased government funding for domestically manufactured drones, has positioned it as a key player in the market. Although recent quarterly earnings fell short of expectations, the upward revision of revenue guidance for 2025 highlights the company's growth potential. Investors seeking exposure to the booming drone sector may find RCAT to be a compelling, albeit high-risk investment opportunity. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.